Over 1.2 billion in profits was faked. Japan was deceived for years, yet no one ended up in jail. Welcome to the Toshiba scandal, one of Japan's biggest corporate frauds. This wasn't some small startup cutting corners or a struggling firm desperate to stay afloat. This was Toshiba, a company that helped build Japan's first radar, pioneered nuclear power, and put its name on everything from laptops to elevators. And yet behind the scenes, its executives were inflating profits, falsifying records, and pressuring employees to bury the truth. How did they pull this off for so long? Who was involved? And what finally blew the whole scheme apart? More importantly, what happened to the company after the truth came out? Welcome to the Silk Road Heist, where we unravel Asia's biggest financial scandals and the untold stories behind corporate deception, corruption, and collapsed empires. This is where money meets power, and truth breaks the silence. Toshiba's history goes all the way back to 1875, when it set up its first factory in Tokyo to support Japan's push toward modernization. But it wasn't until 1939 that the company really took off, after merging with another Japanese company in consumer electronics. The result birthed Tokyo Shibawara Denki, which hit the Tokyo Stock Exchange in 1949, before officially rebranding as Toshiba in 1978. For decades, Toshiba was the company that always seemed to be ahead of the curve. It introduced the world to the microwave oven and even rolled out the first ever color video phone. It didn't stop there. Toshiba also pioneered the magnetic resonance imaging or MRI system, the laptop, the DVD, the world's first inverter air conditioner, and NAND flash memory that makes USB drives possible. By the 1980s, it was one of the most innovative companies on the planet. By 2015, it was pulling in over $63 billion in revenue and employing more than 200,000 people worldwide. It was also one of Japan's 10 most valuable companies. On paper, everything looked solid. But was it? In October 2013, the first real crack started to show. Toshiba admitted that its medical subsidiary, Toshiba Medical Information Systems, had been involved in accounting fraud for years. That was alarming, but it barely scratched the surface of what was really going on. According to Transparently.ai, since 1993, the company had averaged a 64% risk score, placing it among the worst globally in terms of accounting transparency. Every single year from 1994 to 2015, the same issues were flagged: too much debt, shaky working capital, and a habit of tweaking numbers to make things look better than they were. Toshiba had a pattern of revising its earnings, reporting odd gains and losses, and relying on income from affiliates and non-cash sources. Its financial statements didn't quite add up, with cash flow, production, and profits telling different stories. On top of that, its governance was a mess, with complex accounting tricks and stock dilution strategies making it almost impossible to get a clear picture of its financial health. These warning signs had been flashing for decades, but they were either ignored or brushed aside. Then came 2015, the year it all came crashing down. Toshiba's troubles didn't explode overnight. The first real sign that something was off came in February 2015, when Japan's financial watchdog, the Securities and Exchange Surveillance Commission, started looking into the company's accounting practices. But this wasn't some routine check. It was triggered by a whistleblower's email a month earlier. The anonymous tipster accused Toshiba of shady accounting in its infrastructure division, specifically in how it reported revenues and expenses for long-term projects. At first, Toshiba tried to handle things internally. It launched its own investigation and quickly found some irregularities. Executives were tweaking the numbers. But how bad was it? According to Toshiba's initial findings, the company had manipulated profits by 4.4 billion yen, roughly $36 million. That alone was a serious issue. But there was a catch. The committee conducting the investigation wasn't exactly independent. 4 out of 6 members were Toshiba executives, including Chairman Masashi Muromachi, who was leading the probe. With pressure mounting, Toshiba had no choice but to bring in outside investigators. On July 20th, 2015, an independent team of lawyers and accountants delivered their report, and it was far worse than anyone had expected. Toshiba had inflated its annual profits since 2009, covering up losses amounting to at least $1.2 billion. Investigators dug deeper, and the true scale of the fraud became even more shocking as the number was revised to $1.9 billion. And this was where things go from bad to a full-blown corporate horror show. This wasn't just fraud, it was a full-on breakdown of control. Toshiba had built an entire system designed to deceive. The fraud ran through multiple business units and reached all the way to the top. Senior executives, including the last 3 company presidents, were all directly involved. The investigation called out Toshiba's toxic corporate culture, where employees were expected to meet impossible financial targets without question. Poor internal controls and weak governance only made things easier for executives to manipulate the numbers. The report, spanning 90 pages, exposed how Toshiba had systematically overstated profits in key divisions like semiconductors, PCs, and visual products. And it wasn't just one shady accounting trick, it was an entire strategy. Toshiba's financial manipulation was a well-coordinated effort across different business units. Each had its own method, but the goal was always the same: to make the company look stronger than it really was. One of the biggest issues was how Toshiba handled long-term infrastructure projects. The company used the percentage of completion method, which meant it could recognize revenue based on how much of a project was completed, even if the money hadn't actually come in yet. That's not illegal, but only if done correctly. Toshiba, however, was recording revenue way ahead of actual progress. In many cases, it booked profits for work that hadn't even started. Meanwhile, loss-making projects were being reported as losses, further inflating earnings. The company also used more traditional accounting tricks in other divisions. In the semiconductor and digital products units, executives delayed recording expenses by capitalizing them, essentially pushing costs to further periods to make current profits look better. At the same time, they pulled in revenue early, recognizing income before it was actually earned. These techniques, often called window dressing, made Toshiba's financial reports seem far stronger than they were. Year after year, Toshiba kept these tactics going, even as losses piled up. And with little oversight or pushback, the deception continued under multiple CEOs, starting with Atsutoshi Nishida in 2008. By the time investigators uncovered the full extent of the fraud in 2015, the damage had already been done. Executives had spent years inflating profits, dodging losses, and presenting an illusion of stability. But that begs the question, why? What drove a 140-year-old giant, once a symbol of Japan's corporate excellence, to resort to outright fraud? It all came down to pressure, an intense, restless push to meet impossible profits targets. At Toshiba, these targets weren't just goals. They were orders. Executives at the top demanded results, no matter what. Employees were expected to comply without question, and failure simply wasn't an option. This pressure created an environment where bending the rules wasn't just encouragement, it became standard practice. The independent investigation revealed that Toshiba's governance structure was more of a formality than an effective safeguard. The company's internal controls across its finance, auditing, risk management, and securities disclosure divisions failed at every level. They either lacked independence or the authority to challenge senior management. At the core of these governance failures was Toshiba's corporate culture, one that placed unwavering disobedience above ethical decision-making. Employees were expected to comply with the wishes of senior executives without question. While the CEOs didn't explicitly order anyone to falsify reports, they created an environment where employees understood that failing to meet targets was unacceptable. This led business units to manipulate financial data rather than admit shortfalls. This mindset didn't emerge overnight. Back in 2008, CEO Atsutoshi Nishida was steering the company through the global financial crisis. Toshiba, like many others, was struggling, but instead of facing the losses head-on, executives started tweaking the numbers to make things look better. And once they started, there was no turning back. When one CEO stepped down, the next simply continued the same tactics. But as history shows, corporate fraud doesn't stay hidden forever. And when Toshiba's house of cards finally collapsed, the consequences were brutal. The first heads to roll were at the very top. On July 21, 2015, President and CEO Hisao Tanaka resigned, taking full responsibility for the scandal. When he called it the most damaging event for our brand in the company's 140-year history, he certainly wasn't exaggerating. Along with him, two predecessors, Atsutoshi Nishida and Norio Sasaki, also stepped down. They had led the company during the years when the fraudulent accounting took place, so their departures were inevitable. But the shakeup didn't stop there. 6 other high-level executives resigned, and half of Toshiba's board of directors was wiped out. It was one of the biggest leadership purges in Japanese corporate history. However, even though resignations came fast, justice didn't. No one was prosecuted. No one went to jail. Toshiba's punishment was no more than a PR crisis and a stock drop. For a scandal that shook the foundations of Japan's corporate pride, the consequences felt almost nothing. And even with a new leadership team in place, the damage to Toshiba and to Japan's reputation was far from over. Investors fled, consumers lost trust. The brand built over a century ago was suddenly associated with dishonesty. Tanaka himself admitted that the damage to Toshiba's image couldn't be fixed overnight, and the company didn't help its own cause. At first, it avoided calling the scandal financial misconduct and instead used the softer term improper accounting treatment. And when the third-party investigation had exposed the full extent of the fraud, it only made things worse. For shareholders, the scandal was a financial disaster. Toshiba's stock price had already been declining, but when the fraud was revealed, things spiraled out of control. Between April and December 2015, Toshiba's share price plunged by over 40%. Investors lost billions. The Tokyo Stock Exchange responded by placing Toshiba shares on a watch list as securities on alert and delisting the company from a prestigious index that highlights Japan's top-performing businesses. The market value of Toshiba nosedived, and furious investors wasted no time in filing lawsuits. The lawsuits came in waves. 50 individual shareholders sued Toshiba for $2.45 million, arguing that the company's fraud had cost them dearly. 2 major Japanese banks, the Japan Custody Bank and the Japan Master Trust Bank, also went after Toshiba, leading to a compensation order of around 160 million yen. That was just in Japan. In the US, an angry investor filed a class action lawsuit in June 2015 with the Rosen law firm, calling for other shareholders to join. More lawsuits followed from institutional investors, pension funds, and banks. By the time the dust settled, Total claims against Toshiba had reached 178 billion yen, over $1.2 billion. Some cases were settled, including a high-profile one where the Custody Bank of Japan accepted 4.4 billion yen, just a fraction of the 41.1 billion it had originally demanded. Others dragged on, keeping Toshiba in legal limbo for years. Beyond the lawsuits, Toshiba's financial health worsened. The company reported a net loss of $102 million in just one quarter following the scandal. By the end of 2015, the damage was massive. Toshiba had lost about $8 billion in market value and was facing an annual loss of $4.6 billion. Its sales fell to its lowest level in 2.5 years, and the lingering effects of past financial crises like the 2008 Lehman shock and massive losses in its nuclear business after the 2011 Fukushima disaster only made things worse for Toshiba. And as if that weren't bad enough, regulators weren't about to let Toshiba off the hook. Japan's Securities and Exchange Surveillance Commission recommended a record-breaking fine of 7.37 billion yen, or $60 million to the Financial Services Agency. This was the largest fine ever imposed for accounting violations in Japan, dwarfing the previous record of 1.6 billion yen. The Tokyo Stock Exchange also slapped Toshiba with a $760,000 fine for undermining the confidence of shareholders and investors. The company had set aside $70 million in reserves, expecting more penalties to come. And they weren't wrong. More regulatory scrutiny and financial hits were just around the corner. But could Toshiba ever recover? Or was this the beginning of the end for one of Toshiba's most iconic companies? When the scandal broke in 2015, the fallout put Toshiba's entire reputation on the line. The company's leadership knew they had to take drastic action to regain trust. One of the first steps was restructuring the corporate culture from the top down. Transparency and accountability became priorities, and Toshiba pledged to follow the recommendations of the independent investigation. These changes included getting rid of unrealistic profit targets, strengthening internal controls, and tightening corporate governance. Toshiba also set up a stronger whistleblower system so employees could report unethical behavior without fear. And most importantly, they pushed for a real shift in culture, one that prioritized ethics over short-term gains. But fixing internal policies was one thing. Surviving the financial fallout was another. Despite these corrective actions, Toshiba's struggles didn't just end there. By 2016, new financial issues had popped up, this time with its US nuclear subsidiary, Westinghouse. Before the Fukushima disaster in 2011, Toshiba's nuclear business was a goldmine, bringing in over 80% of its operating income. But after the meltdown, demand for nuclear power plummeted, and so did Toshiba's profits. Yet for years, the company downplayed the damage. It wasn't until 2016 that Toshiba finally admitted the full extent of the fallout. But by then, the losses were overwhelming. The company was forced to swallow massive financial hits, $2.3 billion in 2016, and an even more staggering $6.3 billion in 2017. Westinghouse ultimately filed for bankruptcy in 2017, and Toshiba nearly collapsed under the weight of its losses. Auditors refused to sign off on its books, credit agencies downgraded it, and there were serious talks of Toshiba getting delisted from the Tokyo Stock Exchange. The company even admitted it might not survive. In a desperate move, Toshiba sold off Westinghouse in 2018, but by then the damage was done. Years of financial mismanagement, misplaced bets, and delayed recognition of losses had left Toshiba in a state of crisis, one it barely managed to escape. And just when it seemed like the dust was settling, the company's very identity started to shift. After 74 years on the Tokyo Stock Exchange, Toshiba's days as a publicly traded company officially came to an end on December 20th, 2023. The 2 trillion yen, or $14 billion buyout, led by Japan Industrial Partners Inc., was less about celebration and more about survival. For years, Toshiba had been at odds with overseas activist investors who gained influence after a 2017 capital increase. The buyout cut those ties, giving Toshiba a clean slate to focus on fixing the damage left by the Westinghouse disaster and its earlier accounting scandal. Going private also meant reshaping leadership. The new board was stacked with representatives from the consortium, including Chubu Electric Power and Oryx Corp, while CEO Taro Shimada stayed on to steer the company forward. Under the new structure, Toshiba aims to restore its business strength. Yet the company's attempts to rebuild are only overshadowed by the deep scars left by the scandal and the financial missteps of the 2010s. These lingering wounds are not easily healed, and no amount of new leadership can erase the damage done. In the end, Toshiba didn't collapse. Instead, it was swept under the rug, bought out, and quietly removed from the public spotlight. The truth was eventually exposed, but those responsible for the lies walked away unscathed. And maybe in corporate Japan, that's not a scandal. It's just business.